Dear students, today we are going to discuss two areas. The first one is issue of shares at discount, and the second area is issue of shares for consideration other than cash. So here is the first case, issue of shares at discount. I think all of you are known about this case, issue of shares at discount, which means issuing shares at a price less than its face value. So in some cases, company will issue shares in discount, which means they'll be issuing shares at a price which is less than their registered nominal value. So usually this kind of cases happens only in the case of equity shares, in case of sweat equity shares, because as per the Companies Act 2013, Section 53, a company cannot issue shares at discount except in case of sweat equity shares. So in earlier, before this act, Companies Act 2013, it was a common phenomena issuing shares at discount. But as per this section 53 of the Companies Act 2013, now company cannot issue their shares at discount except in the case of sweat equity shares. What do you mean by sweat equity shares? See, listen, sweat equity share is one of the important case. Sweat equity shares is a kind of equity share which means issuing shares to the existing employees or directors of this company. So sweat equity shares means issuing shares to the existing directors or employees of the company for consideration other than cash. I mean, instead of paying cash, issuing shares to the existing employees or directors is termed as sweat equity shares. So now the company can issue shares discount only in the case of sweat equity shares. Even though we need to know the accounting treatment of issue of shares. So whenever the shares are issued on discount, a separate account called discount on issue of shares is a nominal account which will be debited. So our journal entry will be, in case of premium, as you know, we can collect the premium along with the application money or along with the allotment money. But in case of this discount is allowed only with the allotment money. Discount is allowed only with the allotment money. So our journal entry will become like this. Share allotment account ledger, discount on issue of shares. What will be the discount? What the exact amount of discount will be debited in account called discount on issue of shares account debtor to share capital account. Let's see an example. A company issued 100 shares of rupees 10 each at a discount of rupees 2. What it is payable as 3 on application, 5 on allotment, 2 on calls. So the actual value of the share is 10, but now they are issuing the shares at a discount of 2. That means they are issuing their 10 rupees share at rupees 8, 2 rupees discount. So first of all, the company will be receiving the application money bank account to share application. Application it is 3 into 1000, 3000 they will receive. Share application as 3000. Bank account to share application 3000. Then later they will be transferring their share application money to the share capital. Share application account debtor to share capital rupees 3000. Then the discount will come effect only at the time of making the allotment due. So the journal entry for making the allotment due will be share allotment account debtor 3000. Actual 5 rupees is payable on allotment, but there is a discount of 2, that 2 rupees will be applicable with this allotment. So the allotment money will become as 3. So share allotment account debtor 3 into 1000, 3000, discount on issue account debtor, that's discount 2 into 1000 shares 2000 to share capital 5000. Allotment due with discount of rupees 2. So I hope you understood this one. Share allotment account debtor with the discount after deducting discount from the allotment money. So 5 minus 2, 3 into 1000, 3000, and discount account debtor discount is 2, 2 into 10,000, sorry, 2 into 1000 is become 2000 to share capital account. Share capital will be fully called up. Then they will be receiving the allotment money, bank account debtor to share allotment. This 3000 rupees is received here. Allotment money received. So this is the case of discount. Now the discount is not allowed for these companies. I mean, companies are not allowed to issue their shares on discount as per the new regulation of Companies Act. So whenever there is a discount, a new account called discount on issue account will be opened and the discount amount will be debited to that account. So this is the case of issue of shares at discount. So here is the second case, issue of shares for consideration other than cash. There are some circumstances when a company enters into an arrangement with the vendors from whom it has purchased asset, or which means the suppliers from whom it has purchased asset, whereby the latter agrees to accept the payment in the form of fully paid shares of the company issued to them, which means a company purchased, for an example, a company purchased an asset worth of rupees 5 lakh from another company. Instead of paying cash, the company agrees that we'll pay you, or we'll pay you shares instead of cash. So here the company will be paying, or company will be issuing 5 lakh worth of rupees shares to that company instead of paying cash. So where the case is that what is the number of shares to be issued? Suppose this company is having equity shares of rupees 100 each. Now this company have to pay 5 lakh rupees. So how much shares they have to issue? 5 lakh divided by issue price is here 100. So how much share they have to issue? 5,000 shares they have to issue. So they will be issuing 5,000 shares instead of paying 5 lakh rupees. So this is the case of issue of shares for consideration other than cash. When a company issues shares instead of paying cash, it is termed as issue of shares for consideration other than cash. Let's move on an example. Bilal and company purchased a machine from Hightech Limited for 3,80,000. As per purchase agreement, rupees 20,000 were payable in cash and balance by issue of shares of 100 each. What will be the entries passed if the shares are shares are issued at par, at premium, at discount? Issue at shares at par, at discount, and premium. So first of all, we need to get the number of shares to be issued. So if the company issued shares at par, which means if the company planning to issue shares of 100 rupees, for this there is an agreement that they will be paying 20,000 rupees cash. So the balance will be 3 lakh 60,000. 20,000 is to be paid in cash. So the balance is 3 lakh 60,000. So now they have to issue shares worth of rupees 3,60,000. So in these three cases, issue at par or issue at discount of 10% or issue 20% premium, in both three cases we need to calculate the number of shares to be issued. So let's see how to calculate the number of shares to be issued. So the first case, when the shares are issued at par, actual amount payable is 3,60,000. When the shares are issued at par, each share will be having cost of rupees 100. So the amount payable is 3,60,000 divided by 100. They have to issue 3,600 shares. In the second case, when the shares are issued at 10% discount. So how much shares to be issued to meet 3,60,000? The second case is here. If the shares are issued at 10% discount, the share value become as 90 rupees. The share value become as 90 rupees. So the case 3,60,000 divided by 90. Now they have to issue 4,000 shares to meet the liability of 3,60,000. Then the third case, when the shares are issued at 20% premium, so the share price will become as 100 plus 20% become as 120. So the case will be 3,60,000 divided by 120. That means they have to issue 3,000 shares. So this is the three cases when the shares are issued at par. They have to issue 3,600 shares to meet the liability of 3,60,000. If the shares are issued at discount, they have to issue 4,000 shares to meet the liability of 3,60,000. And on the other hand, if the shares are issued at 20% premium, they have to issue only 3,000 shares. Now these shares having much price, much more higher price than earlier. So the number of shares to be issued will become lesser. So now let's move on the journal entry part. So the first case, in all the three cases, the journal entry for the purchasing this asset will be same in all the cases, in all the three cases. So journal entry is here. First of all, we have to buy this asset. So for buying this asset, machinery account ledger to bank to high tech limited. Machinery account ledger, asset worth of rupees 3,80,000, on which 20,000 is paid in cash. So bank account to bank account having credited. Then to high tech limited, there is a liability, I mean the vendor's account or the supplier's account, 3,60,000. So 3,60,000 is payable to the high tech limited. So for this 3,60,000, the company is planning to issue shares. So when the shares issued at par, the first case is here, high tech company limited account debtor to share capital. Now we are issuing 3,600 shares at rupees 100 each. So the case is here, high tech limited company account debtor to share capital. 3,600 shares issued at rupees 100 each. Then there's the first case, there is no difficulties because the shares are worth rupees of 100 and now they have to issue 3,600 shares. They can settle their liability. Then the second case, if the shares are issued at 10% discount, they have to issue how much shares? They have to issue 4,000 shares. So whenever the company is issuing shares at discount, as we have discussed earlier, new account is to be opened called discount on issue of share. So the high tech limited company account debtor 3,60,000 they have to pay. For them, we are issuing 4,000 shares at a discount of 10. So that discount will become as 40,000 rupees. That discount is to be debited to account called discount on issue of shares account to share capital 4 lakh. So in order to set off the liability of 3,60,000, we are issuing shares of 4,000. Number of shares 4,000. So if we are issuing 4,000 shares, we'll incur a loss of 40,000 that is to be debited to discount on issue of shares account. Then if the shares are issued at premium, generally will be high tech limited account ledger. Amount is payable is 3,60,000 to share capital. How much share we have to issue? Only 3,000 shares. So 3,000 into 100 will become as 3 lakh rupees. And the excess we'll get as in premium is to be credited to an account called security premium account, that is 60,000 rupees. So here, in order to set off this liability of 3,60,000, we issued only shares of rupees 3,000. That means when comparing to issued at par, we got profit of 600 shares. We got profit of 600 shares, that is 60,000 rupees. On the other hand, in case of discount, we issued 4,000 shares compared to par value. We issued 400 extra shares for settling this liability. So that's the case of issue at discount. So these are the three cases: issue at par, issue at discount, and issue at premium for consideration other than cash.